Welcome to Echo Trade. It's Jeff Roth again, and we are here again with Eben Burr from Toews Asset Management. This time we're talking about the Managed Risk Architect portfolio, again available on Echo Trade, and we're giving a portfolio update from Eben. So let's dive in. All right, Eben, how's it going? Appreciate you being here.
Good to see you. Thanks for having me.
So you're looking pretty good and flush. You know, I hear you're riding your bike to work every single day. It's probably getting pretty cold out there in New York to be doing that, but good on you.
It's cooling off, but it's not in single digits yet, so it's still relatively comfortable.
It's not single digits yet is a term that we don't know in San Diego. but so let's talk about the portfolio. So it's been an interesting year. We had the Magnificent Seven. Pretty much account for the entire kind of run up until July, and then a little bit of a correction and a pretty big kind of bounce back since. So how have you guys kind of navigated the year so far within the portfolio, and has anything kind of really caused you guys to make adjustments to the portfolio so far?
Yeah, thank you. The Managed Risk Architect portfolio is designed to be a large cap model that has option hedges in place. So it's designed to limit risk.
Yeah.
And to basically, maybe it won't participate in all of the upside of the S&P, but it most certainly won't participate in all the downside either. So it's to limit volatility as part of a portfolio.
Mm-hmm.
And what we've seen this year is that everybody just hangs on every single word that Jerome Powell says.
Yeah.
And is he going to raise interest rates more? Is he going to cut them? When are they going to cut them? And what's the impact going to be? So something that we've seen that we think is potentially problematic is that inflation, while it's coming down, is still higher than their target level, and potentially could just be a pause. Inflation is generally not a totally linear occurrence, and if we do see a cut in rates, that will mean that buyers will be stimulated to take on more loans. Individuals will likely borrow more money, which will then be inflationary. So they have to be really careful about their decisions about when to cut and how much to cut if they cut.
Mm-hmm. Yeah.
Also, onshoring. We are a directionally less global world now, where there's been an impetus to move manufacturing back to the United States or Mexico, so it's closer by, which will likely cost more money, which will have an inflationary effect. So we're not totally convinced that inflation is done yet. And we think it's important to have a part of a portfolio that can be nimble to adjust to what markets are doing rather than just riding it up and down, like a ball.
Yeah. So that's interesting. I mean, so you're looking at it, from the perspective that we could see, again, it's, not linear, that you could see inflation hike back up again, especially if the Fed kind of gets a little bit maybe ahead of itself with dropping interest rates a little bit too soon, which could be, a driver for a stimulus to the market and to the economy.
Yeah. So that stimulus, it's hard to imagine how that doesn't create inflation. Right?
Yeah.
People are all of a sudden borrowing money again. Small businesses are borrowing money again. Rich people, they don't sell shares of things to buy things, right? They borrow money against shares. So if that then becomes a more appealing prospect, you've got all this extra money around again. And what happens with extra money? It gets spent.
Exactly.
Right now, as we've all heard, the real estate market is sort of locked up. But if rates come back down to a more palatable level and people are like, okay, I'm willing to sell, and other people who have a lot of pent up demand are voraciously ready to jump back in, that's going to send housing prices back up again. So I think there is a delicate line that must be walked in terms of what the Fed does with rates.
So, I mean, it sounds like obviously, and this has just been the case for the last, year plus, that interest rates and inflation are the biggest drivers, the biggest impacts on your portfolio and decision-making within the Managed Risk Architect portfolio, right?
Yeah. So, we're using options in there. So we're always invested in the S&P for about 80% of the portfolio.
Yeah.
And then for 20% of it, roughly, we can go in and out of small, mid, and large cap US companies. So there is a portion that can get fully out and become totally defensive, while the rest of it remains fully invested in the S&P, but has a hedge in place. And the way to think of that is like applying the brake to your car evenly, right? At first, there's not much impact, but the further you apply it, the more risk management you get, right? The slower you go. So that's a kind of way to conceptualize how that strategy might work in a declining market. And then on the way back up, we're able to capture much of that upside, and also being able to buy back in at a lower price with that 20%. So
exactly.
We're really enthusiastic about the risk management element of it, as well as the up capture.
Yeah. So, I mean, I was going to say, it sounds like you guys are really obviously kind of preparing yourselves for both sides, right? Everybody's kind of talking about whether next year there's going to be an actual recession or if it's going to be, just zero growth. But again, that if the Fed lowers interest rates, anything but it's got to be a stimulus to the market and to the economy. And then that could raise inflation as well. So there's kind of both sides that you guys are preparing for. I mean, what are you guys, you're preparing for both sides, it sounds like. What are you excited about? Is there anything that you're optimistic about on either side of that coin?
Yes. So if rates do start to come down, the small mid portion of this portfolio will likely soar. Small and mid-sized companies are more debt reliant.
Yeah.
So they've pulled back. But if all of a sudden money becomes cheaper to borrow, companies that are poised for expansion but can't borrow the money at the moment, or they're about to have to refinance debt at a level that would cause them to have to fire people just to be able to afford repaying the potentially double interest rate that they might be burdened with, they'll be able to expand. So it would be the catapult for companies that are poised for expansion, or the relief for those that are about to be burdened by higher debt levels.
Exactly. So do you guys have exposure to some of those companies that could have a pretty negative impact once they roll over that debt into potentially can still, much higher interest rates?
Yeah, so about 12% of the portfolio is exposed to companies that would likely have a boost from dropping rates. But then, I mean, if you look at the S&P, which is 80% of the portfolio, they all thrive on debt as well, and they'll all be relieved to not be paying, 8% or whatever it is that they might be burdened with when they have loans at 3 that are going to roll over. So I think for all businesses to have less expensive money to borrow is a benefit.
Exactly. Well, thanks for the time, Eben. Investors, you guys can check out the Managed Risk Architect portfolio available on Echo Trade. Essentially, be able to copy the portfolio and the expertise from Eben and the team at Toews. Eben, thanks again. Have a great rest of the week.
Thanks very much. Take care.